Well, thank you. If you have made it here all the way to the presentation on fixed distributions, we have been through all of these important forks in the road, from stocks versus bonds to how to choose the equity asset classes, then how to put them together in portfolios. And then we've gone to the fine tuning table where we figure out how to balance fixed income with equity. And then we look at the process of accumulating wealth during the years we're working. And the assumption is we're probably, for most cases, talking about putting money into a 401k or an IRA, but we showed all the different ways, different combinations of different equity portfolios, along with different amounts of fixed income during those accumulation years. Now we get to the point where it's time to enjoy the last, let's call it a third of our life, and we're going to be taking money out. We're going to start enjoying the money or replacing the money we made at work with the money we had saved during all those years of accumulation. This is, I think, a fascinating decision-making process. When we get to the next presentation, we're going to talk about a way of taking money out that my wife and I have adopted. On the other hand, today we're going to talk about an approach that I think that most people probably would be considering, and that is that we have saved enough. We have saved enough to retire. We're excited. We don't want to work anymore. We just want to start living off of the proceeds of all that great saving that we did. So the fixed distributions, I want to make a little change in the order here. What I want to do in this particular case is I want to make the disclaimer early in the presentation rather than at the end of the presentation, because at this point, there are so many different things that you could do, investment choices you could make, timing that you could make, that as an educator, as a teacher, I can talk in generalities, but you have a particular set of moving parts that are going to make this all work. Now, admittedly, most people are not going to put the time into considering how to take distributions most efficiently. But in this particular case, what we're going to do is we're going to show many of the moving parts, not all, but I highly suggest that you spend a little time with a professional to go over whatever you decide to be your long-term commitment to distribution. So when they say that this is for information here and informational and entertainment purposes, it doesn't mean that I'm not dead serious about what I'm trying to share with you. But I am saying that there are so many ways that you might change things that it takes some careful, I think, consideration. So let's talk about why there are so many things to take into consideration. First of all, we all ask the question, when will I have enough to retire? And that's a fascinating question. And the answer is in many ways life-changing, because you can decide, I want to retire when I have enough. You may have heard that the 4% distribution, and we'll talk about that and show some numbers, but the 4% distribution rate out of your $1 million, you're going to take out 40,000, and because you retired when you just had enough, there's kind of not so much room for error in this approach. And so you take out your 40,000 and you then make adjustments for inflation in the future. That is the relationship you have with your money and your retirement and how much money you will either want to or need to take out. Other people, and this is what we'll talk about next week, other people will decide to wait. Don't retire when you have enough, but wait until you have more than enough. I mean, there's so many different decisions you might make when you have more than enough. You could take out more if you have more than enough than if you have just enough. You could deal with inflation in a different way if you had more than just enough. Now you have to make also whether you've got just enough or more than enough, you also have to decide how much in equities, how much in fixed income, and which of those equity portfolios am I going to use to fund whatever growth I'm looking for in the portfolio during these years of retirement. And of course, you not only need to figure out what equities you need to be using, but you got to figure out what bonds you're going to be using. And so now I'm going to show you, as always, lots and lots of numbers. And my hope is that we'll somehow figure out, and I mean you, will somehow figure out, yes, there is a column here that represents who I am and what I am willing to to expose myself to in terms of risk, and what kind of reward or distribution am I going to get for that. So how do we know when we have enough? Well, if you really think that you're going to be using the 4% strategy, it seems to me that you have to determine what your cost of living is. And now here is a point where another set of eyes could be helpful. Because if you put together your budget, you might underestimate the real need, and this would be important. Because if you, in fact, are going to, if you have $1 million and if your cost of living is 40,000, then you know there's that 4% relationship. On the other hand, if it turns out your real cost of living is 45,000, now I'm talking about the kinds of cost of living number that is as accurate as possible, but doesn't take into consideration every possible bad thing that could happen. But you need to find out what is that cost of living, and then you want to look at how much of your cost of living. Let's say, for example, that your cost of living is $70,000, but you're going to have income that is dependable, that will be, let's say, Social Security. Now, if Social Security is $30,000 and you need to figure out how to make up for that shortfall between that 70,000 less the 30 is 40, well, there you have it. You have a $40,000 need to be met by this distribution you're going to take out of your investments. I mean, this is obviously very easy to understand, and I think it's the way most people will try to go through this. But now, if you read about distribution rates, there are some people who are saying that on a basis of having enough, not more than enough, that you can take out anywhere from 3.5 to 4.5%. Different experts have different numbers. Morningstar recently is talking more about 3.5%. Bill Bengen is talking about 4.5%. I do know, and again, we'll talk about this next session, that when you have more than enough, if you have oversaved, you can be easily talking about 5, as much as 6% to come out of the portfolio. So you now know that if you have Social Security for 30,000 and you can take out 4%, 40,000 out of your million, you're in a position to retire. Now, as we move forward, we are going to have to both figure out how much to have in stock and how much to have in bonds. But in the equity portion, you went through, I hope, already the discussion in the Sound Investing Portfolio. So that was boot camp number 3. And in that presentation, we looked at a bunch of different strategies in terms of how to put the equity portfolio together. We looked at the S&P 500. We looked at a portfolio of 10 different equity asset classes that were worldwide, both U.S. and international. We looked at a portfolio of 4 funds that was a balance of 2 international, 2 U.S. We looked at a group of 4 U.S. Equity asset classes. We looked at all value, 5 different value funds, some U.S., some international. We looked at all U.S. value, only U.S., but large and small value. We talked about all small cap value, not with the idea that we'd likely put all of our money in small cap value, but that, some people might put a portion of their portfolio for life into small cap value. That's worldwide there. And here's the U.S. all small cap value. And the last one was the combination 50-50 small cap value in the U.S. and the S&P 500 or a similar fund in that'd be large cap blend in the U.S. And then we showed you the different returns for different decades. We showed you the good years and the bad years. And after you went through all of these, you somehow have to select one of these. Well, you don't have to, but I think at some point you've got to decide, how am I going to configure my portfolio when I am in retirement, the equity portion? Now, what I'm going to show you today is I'm going to look at the S&P 500 only for the equity. That is, in essence, the way most people are invested. Now, some people have the total U.S. and the total international portfolio put together, but it still becomes a large cap blend portfolio. And so I am not uncomfortable using the S&P 500 for this part of the portfolio. For people who want to be in something that's pretty doggone safe in terms of equity compared to the other more volatile equity asset classes. I'm also going to show, to kind of take it to the opposite end here, what happens if you use, for the equity portion of the portfolio, a combination of U.S. Large blend and U.S. small cap value. As we noted in the earlier discussions, those two have a tendency to be at the top and the bottom of performance amongst the 4 major U.S. equity asset classes. So it turns out putting those 2 equity asset classes together actually has a lot of the same risk exposure and characteristics as the S&P 500. And in fact, and this becomes way more important in retirement than it does when you're accumulating. But when we look at the down years only, the S&P 500 had 11 down years from 1970 to 2024. The accumulation of all of those annual losses was 159.2%. If we looked over here at the small cap value, the combination or accumulations, the sum of all of the negative years, there were 12 of them, but that total was 141%. So you might say, looking at these numbers, if you didn't know what was in those portfolios, that whatever was in this portfolio on the far right that had a loss of 141 was actually a little less risky than the one that had a sum of the losses of 159%. So we're going to compare those two. You, on the other hand, because you're looking for the perfect fit for you, are going to want to dig kind of into the same numbers that I'm going to look at on the tables that will show the results with all of these other different portfolios here. And then in each case, to determine what happened to the money, how much money you made as you were taking money out. And by the way, the assumption is going to be when you see the tables that we take the money out at the first of the year. That's how my wife and I happen to take it out. But you could take it out quarterly, you could take it out monthly. And when you make that decision, whether you take it out up front or monthly or quarterly, it is going to change in the long run the total return. And for those people who take it out monthly, there should be a better long-term return than what my wife and I do in taking it out at the first of the year. And why would we choose to do something that's going to lead to lower likely returns? We choose it because it becomes much emotionally acceptable to take that money out, know it's there for the year, as opposed to getting into a tough market in the, or say in the early months of the year, the market's going down. We might have a chance to pull back. But in this particular case, we're assuming we've got the money for the year. We'll make that decision about pulling back at the end of the year. But remember, as we look at these tables that are coming up in terms of distributions, that you really are going to be mechanically taking the money out. It assumes you take the money out, the next year you increase it for inflation, and you do that regardless of what's going on in the market. Now, we know that's probably not how people will do it because they will, maybe because the market's been bad, they'll pull back, they'll pull in their horns, they'll be a little more cautious about spending money. Maybe when they go out to dinner, they don't go out and order the most expensive bottle of wine. I don't know what it is, but they will find ways to cut the corners. But these are the tables. These are the tables, as you remember, the fine-tuning tables that show equities on the right and bonds over here on the left. And each year they show the return of combining those two asset classes, the equity and the fixed income. In each of the tables that we have, the fine-tuning tables, the equity is going to be different. In this particular case, it happens to be the S&P 500. So I go to the next table here, and in the second case, we're going to be using the two-fund strategy. In this particular case, the U.S. two-fund equity. Now we're going to have the returns of the combination over here in the equity portion of the small cap and the large cap blend, and the implications of all of those different combinations, and exposing to different levels of risk. And if you didn't watch the fine-tuning your asset allocation bootcamp piece, I hope that you'll go back and take a look at that. Now, I'm going to move on to the next table that reflects the use of the two-fund strategy instead of the S&P 500 only. This one is half S&P 500 and half small cap value. Everything else is going to stay the same. The same $40,000 adjusted for the same inflation. I'm going to be looking again at that 20-year period. We'll take a peek at the entire period again before we move on after we look at the 20, because I want you to now, after having just gone through that with the S&P 500, notice notice the similarities, notice the differences. One thing that I notice is when I look at the 100% equity portfolio, that having the small cap value in that 1970 through 79 period did not add any value. As a matter of fact, it was even more risky to the downside at the bottom of that period after the 73-74 decline. It was down to 636,000 compared to the more than 700,000 in the S&P 500. These people were not feeling any better. It was a disaster. And in fact, there was really nowhere that you could hide in equities that would have made you feel better. I'm talking now about small value, small blend, large value, large blend. On the other hand, if we look at the 60-40, we actually, and you'll see it fell to a lower level, 849. But by the end of that decade, because the small cap value did well in the last half of that decade, you ended up with 1.5, this is the 60-40, $1.5 million. And if you were all equities, all S&P 500, you then ended up with about 1.5 million as well. And now you're doing better than the all bonds at 1.3 million. And by the end of the 20-year period, remember, the 80s were a great 10-year period. The all bonds were now at the same $2.4 million. But the all equities with the two fund strategies, instead of being worth about almost 2.2 million, you are worth 5.6 million. So at the end of 20 years, there was a significant advantage to the two fund strategy over the four funds, over the S&P 500. And the 60-40 is now behind because it was less risky. It's at $4.7 million. So this 20 years throws inflation at us. It throws a bad market at us. It throws a good market at us. It has a period that small cap value did better than large cap blend. It had another period that large cap blend did better than small cap value. It did all of the things that we believe will likely happen over a long, healthy retirement. And by the way, if we go back for a second and look at the table that goes all the way back to 2000, down to 2024, what you'll see there is that while the S&P 500 was over 14 million, the 100% equity was over $180 million. Now, that is the impact of compounding money at the same time as you're taking money out, at the same time as you're adjusting for inflation. And the 60-40 portfolio ended up with almost $59 million. Now, if you went back and looked at the S&P 500 only at that end of the period, they had about $2.6 million. I mean, this is a huge difference. And one of the reasons that I think that people, the two kinds of people that could like the idea of the combination of the small and the larger companies. One is they might like the fact that they're non-correlated and tend to offset each other in most years in terms of who was best and who was worst and actually reduce the volatility 1 year at a time. But it also gives you the chance for the home run. Now, the problem here is if you're down there with that $58 million in the 60/40 after 55 years, you must have probably retired at age 40. So seems to me that that is a column that people who are part of this fire movement, the people who are trying to retire early, and there are lots of people working to retire at age 40, 45, or 50, these tables become legitimate for them because they could be around for that period of time. Now we go to a different step. I want to take less risk. We started out with the standard way of doing this, with the 4%, the Bill Bengen 4% distribution. But what if we figured out how to live on 30,000 instead of 40? What if we were more frugal? Or what if we had $40,000 in Social Security and only need to take out $30,000? Well, boy, if you can take out less, that is one big step through building more. That is a big step. In fact, if you can take out less, in theory, you might even be willing to take a little more risk when you see the numbers. But let's go to now. We've got the same inflation we're dealing with. We have just a smaller amount of money coming out of the portfolio. It is kind of amazing how it changes things because when we now look at the 20-year period from 1970 to 1989, and we have the S&P 500, and in essence, we take out $20,000. Well, we're not sure how much less it's going to be, but it's going to be less because we took out 30 and adjusted for inflation rather than 40. But the first thing I see is that in the bad year of finally 1974, when you again, that was the end of the 73-74 sell-off, you have $750,000. And by the time you get down to that end of that first decade, instead of having a little bit under a million, you have almost $1.2 million. And that's because you took out $10,000 less, $200,000 more, because you lived on or took out that smaller amount. It's really huge. And instead, for example, as we look at the 60/40 strategy, at the end of that 20 years, you're left with about $4 million as opposed to 2.6 million. Taking less has a huge impact. And so, and also let's look over at the all fixed income. Instead of being left with, at the end of the first decade, instead of being left with let's see, what was it? It was about 1.3 million. Now you got 1.55 million. Instead of ending up with about 2.4 million, at the end of the 20 years, it's 3.5 million. So that adjustment to 40 to 30,000, it may not seem like a lot, but it is. It's a big deal. And if we then look at the two fund strategy, and the 30,000, and we look again, right, let's go right to the 20 years, you will see that the bottom line number for the two fund strategy, which was before about 4.6, 4.7 million, now it's 6.4 million at the end of 20 years. Both these tables represent taking out, whether it's the S&P 500 or the two fund strategy, you're taking out exactly the same amount of money, the $30,000 adjusted for inflation. And so again, this is a big, big difference. And if we look at the two fund strategy going back over the entire period in the 60/40, at the end of the 55 years, you've got over $100,000 in that portfolio. And by the way, the total distributions you would have taken out, $6.8 million. Now, I have a feeling that if this is what happened, people would take out more money. But in order to keep everything fair, it's mechanical. That's the implications of being able to invest in a balanced portfolio, having good times when equities are up and having the defense there when equities are down. You'll notice You notice even with only taking $30,000 out and adjusting, and even for using the two fund strategy, at the end of 1974, you're still sitting there with less than you started. And I will tell you what's possible. What is possible is that you may have been in the 60/40, and you may not be absolutely panicked. But your next door neighbor was in an all equity portfolio, and you were reading about the death of equities. And you might have cashed in feeling, God, am I lucky to walk away with $899,000? That's most of what we started with, and we've been living off it. Now let's just move our money into bonds because bonds are actually over that at that end of 1974, the bonds had about 1.3 million. You might have thought it was time to move to something that's been doing better. This is what we call chasing performance, and it's very common. And when you look at the 100% equity, having taken out the 30,000 adjusted for inflation with the two fund strategy, at the end of the 55 years, you've got almost $300,000. Now, again, it seems almost impossible, but that is, in essence, the impact of higher rates of return. And the difference between the S&P 500 and the two fund strategy, well, as a matter of fact, I can see it right here with the S&P 500. I'm looking at table D9 dot period or dot 3. The S&P 500 is worth 86.7 million versus the 297 million in the two fund strategy. That is the difference of about a 3% compound rate of return. That's all it is, the difference of an additional 3%. Now we go the other way. In table D15, we go to taking more money out instead of taking less. Now, all of a sudden, as you look at the table that represents the S&P 500, taking out 50,000 and adjusting for inflation, remember. In fact, at the end of the 10 years, when you start with 50,000, inflation has taken that distribution up to almost $90,000. When you go out 20 years, it takes it up to about $560,000. If you just mechanically, every year, you got the check for 10% more. I'm sorry, for the increase in inflation. But here is what we have to see. We have to see that it didn't last very long, that you were asking too much from the portfolio. The S&P 500 was not good enough. Now, part of this is because you started and the market wasn't good for the first 10 years. Well, I think when we retire, we should be assuming the market's not going to be good for the first 10 years. But the 60/40, it was able to make it for about 28 years, 27 years, and then it was broke. The 100% equity was able to make it for 22 years, and then everything was gone. Now, again, this is being mechanical. We are required to do exactly what the formula says. And probably you wouldn't have run yourself into the ground like this. You would have changed your lifestyle. You wouldn't have taken out so much money. Maybe you would have done a reverse mortgage on your house and got the money someplace else so that you weren't having to continue to take money out of these investments that weren't doing what you had expected. Because after all, if you're in an all equity market that compounds at 10%, how can you go broke taking out 5? And of course, the reason is it wasn't just the 5, it was the 5 plus inflation. And it wasn't just the 5 plus inflation, it was also that sometimes markets go down before they go up. I will never forget the client that we very carefully made it clear how much risk they were taking, that invested a substantial amount of money, willing to lose 20%. And at the end of the first month, after having lost 1%, they stopped. They bailed out. They quit. And I said, I asked why. We were very clear that you would lose money along the way. And the answer was because I thought I would make money before I lost it. I didn't realize I would lose my principal, the part that was mine. And that's not a crazy person. It's a person who has kind of relatively normal feelings about loss. That's why we know. In fact, when I was with a client who said they had a 20% risk tolerance, let's say they had a $1 million portfolio, and they told me they could lose 20%. I said, well, I just want to make sure now. You got $1 million, and if a year from now it's down to 800, is that going to be okay? And they would change their mind about what their risk tolerance was, because when you talked in terms of real dollars, they looked at it differently than if you talked about a percentage. That's why decision making around money and investments is pretty tricky business, and it's really easy to be oversold because you don't really understand or maybe haven't lived through a period of time that took your life savings away from you at the very moment that you no longer have a job. So the S&P 500 doesn't work with 50,000. And look at here, even with the two-fund strategy, yes, with a 50-50 strategy, it makes it through the 55 years. And with 4.7 million, with the 60/40, it made it through with 13 million. But in many of the other columns here, with the 20% in equities, you make it through year about 2005. So if you needed more than 30 years of money, it might have been hard to get out of that a combination of bonds and stocks if you took too much out. And so it shouldn't surprise you to see that when you take out 6%, 60,000, it just gets worse. I don't care whether you're in the S&P 500 or you're in the two fund strategy. They barely, well, the two fund strategy, if you had some equities, you might have lasted for 25 to 28, 27 years, but it doesn't last very long when you're that aggressive. Now, I can tell you at my age, 81, if instead of taking out 5% a year, we took out 6% a year, it would likely do just fine. And but the fact is, the 5% not only covers our cost of living, but it covers the amount that we want to give to others. So we don't need to take out more. But taking out too much can be costly. So that's the conversation around fixed distributions. Let me just to look back on this now. In this process, you are needing to figure out how much you need and figuring out how much that would be then and setting it up so that you're taking money out on an inflation adjusted basis first of each year. That's what this is built on. It's built on you deciding how much in equity and how much in fixed income. It's depending on you to pick the portfolio, what combination of equity asset classes. In a target date fund, by the way, you generally get large cap, US and international blend. So as I said earlier, it's very much like the S&P 500. Now, the international part hasn't been doing as well lately, so it doesn't look like the S&P 500. But over a longer period of time than we've seen recently, it has been very similar. And beyond that, it's pretty simple. It's what kind of a supportive market are you going to face, or difficult market? We just don't know. And we just don't know what kind of inflation. I do know that if you use the Merriman lifetime investment calculator that we have on our site, and we'll have a link to that calculator in the footnotes, that you can start at different periods of time. You don't have to start in 1970. You could start in 1980. You could start in 1990. And what it does is when it gets to the end of the period of time, it circles back and starts again in 1970, so that you will still get 55 or 54. I don't know that it's been updated for this year, actually. I should find that out. So next week, we're going to be talking about flexible distributions. What I consider to be the greatest financial luxury for somebody who retires, and that is to have more than enough so that the market doesn't have to create as much anxiety. Because when you have more than enough, in many ways you can take more risk, but in many ways you have the ability to take a lot less risk, depending on your emotions around spending and how you want to live your life. And I will also, in that presentation, talk about the importance of defense in investing. It is probably, realistically, if you look at all the ways that you make money as an investor, the things that you need to do, it is almost all about defense. And we'll look at that along with the flexible distributions. Thank you for watching. And remember, we're looking for your questions. Email me, paul@paulmerriman.com. And we are starting to populate our boot camp pages with some of those questions and our answers, and we'll have lots more of them. I am about to take a 1 week vacation. I'm sorry, a 1 month vacation, and try to put work behind me. The one thing I'm going to continue to do, I'm not going to be recording podcasts. We're going to have some other podcasts where I'm being interviewed and some things that I think you'll find of interest. And our newsletters will be populated with some really interesting things from some of our truth tellers that I hope you enjoy. But while I'm away, the one thing that my wife and I have agreed is I will be able to continue answering questions because those are real easy to do, and I certainly want to try to answer those questions that you have. So, thank you as always, and I hope this information helps you put together a portfolio that serves you with everything that you need in retirement. Thank you.